Howdy, y'all. Welcome to Liberty Call. Today is Thursday, September 7th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is another red day, mostly on the markets here domestically. And let me scroll down and see. Yeah, I see a lot of red mostly across the globe as far as the major indexes out there. So again, this has not been a good week for the markets, but again, not unexpected. I personally thought that we would see some declines in equities here a lot sooner than now, but things never go as planned. So, alrighty. Well, if it's your first time watching the Liberty Call, I'm glad you're here. Thank you very much. If you could do me one favor, one thing, okay, maybe two. Press the like button, the subscribe button, and the notification bell so you know when we go live, because you don't want to miss any of this amazing knowledge that I'm passing out. I mean, we're going to cover what the markets did today, a market recap, the jobs data, and the doom loop. Dun, dun, dun. Let's go ahead and, first, if it is your first time watching, thank you very much. And I already did that. Thank you. Like, share, subscribe, blah, blah, blah. See, in my head, I have a sequence, and then sometimes I get mixed up. All right, let's go ahead and jump into the numbers for today. Dow Jones was one of the outliers. It was in the green. It was up 0.17%, 57 points, closed at 34,500. The S&P 500 was down 0.31%, closed at 4451. Nasdaq down 0.89%, closed at 13,748. The VIX was flat. It's still at 1445. Canada was down 0.47. Brazil was down 1.15, and Mexico down 0.92. Western Europe, Germany was down 0.14. The UK was up 0.21%. France was up 0.03, so basically flat. Spain was down 0.05. Italy down 0.2. Switzerland up 0.63. And Portugal down 0.29. Russian exchanges both in the red. MOX down 2.35. RTSI down 2.36. And the overnights, the Nikkei in Japan was down 0.73%. Australia down 1.19. New Zealand down 0.22. In China, the Shanghai was down 1.13%. The Shenzhen component down 1.84. China A50 down 1.22. DJ Shanghai down 1.27. Hang Seng down 1.32. And Taiwan weighted down 0.71. So it's kind of a bloodbath today. Well, not really too terrible, but just lots and lots of red. It seems to be the trend this week. So we'll see if the trend continues into next week. And we'll also tomorrow cover, see how the markets did for the week as a whole. Okay, let's go ahead and hop into the market recap and see what happened today. S&P, Nasdaq fall as Apple drags. Jobless claims data fuels rate jitters. All right, on Thursday, the S&P 500 and Nasdaq experienced declines, primarily driven by Apple and concerns over chip stocks due to China's restrictions on iPhone use. And we covered that yesterday. China is basically kind of doing the same thing that America does. And they're saying, nope, you can't use iPhones, or government personnel can't use iPhones. So I think it's a little tit for tat. Apple shares fell by 3.5% following reports of China expanding its ban on iPhones for state employees, including staff at central government agencies. This development had a cascading effect on Apple suppliers and companies with significant exposure to China, causing the S&P 500 technology sector to decline by 1.9%, making it the worst performing sector among the index's 11 major sectors. In contrast, the Dow Jones Industrial Average outperformed the S&P and Nasdaq because of its composition. Apple has less influence on the Dow due to its price-weighted methodology, while it's a significant weight in the market capitalization-weighted S&P 500. Investors also digested the U.S. Labor Department report, which showed a decrease in the number of Americans filing for unemployment claims to 216,000, marking the lowest level since February. However, concerns persisted regarding the Federal Reserve's stance on interest rates and sticky inflation as they awaited inflation data for August. Craig Fair, head of investment strategy at Edward Jones, noted that markets were caught between the potential for a softening economy, which could provide the Fed with more flexibility, and the need for resilience in the economy, which might keep the Fed from adjusting policy. Defensive utilities emerged as the biggest gainers among the S&P sectors, reflecting the market's risk-off sentiment. The Philadelphia Semiconductor Index declined by 2%, and shares of Apple suppliers, including Skyworks Solutions, Qualcomm, and Qorvo, were down by more than 7%. News from China regarding iPhone bans and data showing a decline in China's exports and imports also weighed on sentiment, particularly in technology. U.S.-listed Chinese firms such as PDD Holdings, JD.com, Alibaba, and Baidu saw their shares decline. Despite a 93% probability of the Fed leaving interest rates unchanged in September, concerns about the November meeting and the U.S.-China relationship remained, contributing to a cautious stance in the market. So we'll see what happens. But I mean, what do you expect? I mean, our government here has basically been trying to get TikTok kicked off the interwebs, or at least here domestically. So it's kind of again, a tit for tat. So don't be surprised. All right, next up, some labor data. U.S. layoff evidence remains scant. Labor costs ease. All right. The latest data from the Labor Department suggests that U.S. employers are not yet significantly increasing layoffs, defying earlier predictions of a labor market slowdown amidst the Federal Reserve's efforts to curb it. New filings for state unemployment benefits unexpectedly fell last week to their lowest level since February. Furthermore, the number of people receiving jobless benefits for more than 1 week dropped to its lowest point since July. These figures indicate that the job market remains resilient by historical standards. Despite other recent data suggesting of a softening job market, after the exceptionally tight conditions caused by the COVID-19 pandemic, this new data underscores the robustness of the job market. This may lead the Federal Reserve to maintain high borrowing costs for an extended period to combat inflation effectively. The central bank has been steadily raising interest rates over the past 18 months. The report also revealed that labor cost pressures eased substantially in the second quarter, while worker production saw its most significant increase in nearly 3 years. However, these improvements may not be enough for the Federal Reserve to ease its stance on inflation. The decline in unemployment claims and the ongoing resilience of the job market may signal to the Fed that further labor market weakening is needed to meet its inflation target. In detail, initial claims for state unemployment benefits dropped 13,000 to 216,000, the lowest level since February. This marks the fourth consecutive weekly decline, contrary to economists' expectations of an increase in new claims. Continuing claims, considered a proxy for hiring, also decreased by 40,000 to 1.679 million, the lowest level since July. These figures indicate that the job market isn't showing signs of imminent weakness. The data suggests that laid-off workers are finding new jobs relatively easily, or could indicate that actual layoff activity is lower than the announcements made by large businesses. Overall, the numbers indicate that the U.S. job market isn't on the verge of a near-term slowdown. However, the Federal Reserve is likely to maintain its pressure on the economy, aiming to tackle inflation effectively. Well, I don't know if I'd call it effectively. I mean, the Fed created this problem. Now they're going to want to attaboy for fixing it. All right. Last up, as an article comes from the Wall Street Journal titled "Real Estate Doom Loop Threatens America's Banks." It's written by Shane Shiflett and Conrad Putzier. All right, let me get my summary up here and see what they had to say. All right, regional banks in the United States, including Bank OZK, have significantly expanded their commercial real estate lending in recent years, leading to concerns as their commercial real estate market experiences a downturn. These banks not only have increased their lending to landlords, but have also engaged in indirect lending, including loans to non-bank mortgage companies and investments in commercial mortgage-backed securities. This broader exposure to commercial real estate amounts to approximately $3.6 trillion, about 20% of their deposits. The current commercial real estate market faces challenges due to rising interest rates and high vacancy rates, causing real estate developers to default on loans. As a result, banks are forced to write down the value of these mortgages, and some properties end up in the possession of the banks. The potential for losses in the commercial real estate sector could trigger a negative feedback loop in the banking industry. Losses on loans may lead banks to reduce lending, causing property prices to further decline and resulting in additional losses. The situation is exacerbated by rising interest rates, which have reduced banks' access to cheap deposits, limiting their ability to lend and absorb losses. Some banks have already reported losses related to commercial real estate. M&T Bank, for instance, reported that nearly 20% of its loans to office landlords were at higher risk of default. Additionally, the recent failure of several regional banks has raised concerns about the sector's stability. Despite warnings from regulators about the risks associated with commercial real estate lending, banks continued to increase lending and loosened underwriting standards. A similar strategy was observed after the 2008 financial crisis, when regulators allowed banks to work with struggling borrowers and keep mortgages on their books at face value. However, this approach may not be as effective this time due to the significant rise in interest rates. Overall, the commercial real estate market's challenges pose a threat to the banking industry and could potentially lead to a wider economic impact. With many properties expected to be sold at lower prices, the situation remains precarious, and the true extent of the losses may continue to unfold in the coming years. So that's not good. I mean, pretty much the last 3 years, I've been staying as far away from real estate or commercial real estate as possible, simply because we haven't gone back to work. I mean, yes, the economy has gone back to work, but there's a lot of people still working from home. There's a lot of retail and office space that's just sitting empty. So for right now, I would say tread lightly. If you're gonna, invest in anything, be very careful in the real estate market, especially the commercial real estate market, just because, if there's a massive paradigm shift in how businesses run in the next, say, 5 to 10 years, all this empty space is just going to go by the wayside. I mean, it'll probably get repurposed over time, but, in the short term, the values of those assets are probably not going to do very well. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.